Today, crunch time cometh. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news with a distinctively Australian flavour. Well, the Dow jumped on Wednesday, led by growth stocks, including tech, as Treasury yields slipped, after the Federal Reserve delivered its biggest rate rise since 1994. The Federal Reserve raised interest rates by 75 basis points, and Chair Jerome Powell signalled another big move next month, intensifying a fight to contain rampant inflation.
The labour market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point, and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet.
Slammed by critics for not anticipating the fastest price gains in 4 decades and then being too slow to respond, Powell and his colleagues on Wednesday intensified their efforts to cool prices by lifting that target rate. And that means the federal funds rate is now 1.5 to 1.75%. And he admitted that the recent upside inflation had forced the central bank's hand into tightening monetary policy by more than expected. At the press conference that followed, Powell said there was a need to, quote, front-load rate hikes, signalling the aggressive hikes now may not be followed up in the future with similarly aggressive hikes. And he said that either a 50 basis point or 75 basis point rate hike seems most likely at the next meeting of the central bank's Federal Open Market Committee. They forecast interest rates would rise even further this year to 3.4% by December and 3.8% by the end of 2023. That was a big upgrade from the 1.9 and 2.8% that they penciled in during their March projections. Clearly, today's 75 basis point increase is an unusually large one, and I don't expect moves of this size to be common, he told a post-meeting press conference in Washington, remarks that were cheered in financial markets as he took the risk of a string of supersize increases off the table. Stocks climbed, halting a 5-day rout that took 10% off the S&P 500 while Treasury yields tumbled and the dollar pushed lower. Economists at Barclays said that they expect the Fed will only raise rates by 0.5 point next month. Powell's press conference came across much less hawkish than the initial message from the 75 basis point increase and upgraded rate projections for 2023. Evercore ISI's Krishna Gua and Peter Williams wrote in a note to clients, flexibly hawkish came across as a risk-friendly combination in asset markets. Still, the move on Wednesday was more hawkish than the 50 basis point shift previously signalled by the chair, who explained that the stepped-up pace pointed to a run of data that showed inflation and expectations for it accelerating. Late last week, of course, the survey from the University of Michigan showed consumer inflation expectations pushing higher. Respondents anticipated inflation rising 5.4% in the year ahead. That's the highest since 1981. And Powell did comment that consumers rightly were looking not at the core inflation rate, but the headline rate. Longer-term price expectations, of course, also picked up. The preliminary June readings were quite eye-catching, and we noticed that, Powell said. One of the factors in our deciding to move ahead with 75 basis points today was that we saw inflation expectations growing, in addition to the hotter-than-expected rise in the Consumer Price Index for May release on Friday. That said, even after the fresh inflation data, most economists and traders still saw a 0.5 point increase as the most likely outcome, in part because the Fed doesn't like to spring surprises on markets or inject doubts over the strength of its guidance. But most traders and economists switched their forecast to a 75 basis point hike after media reports on Monday, suggesting policymakers would consider such a move. While the median projection of officials was a repeat rate of 3.8% in 2023, 5 projected a federal funds rate above 4%. And traders in futures markets were betting on a peak rate of around 4% ahead of the release, bets that were dialed back to around 3.8% after Powell spoke. The most notable change in the policy statement is the omission of the phrase "the committee expects inflation to return to its 2% objective." That suggests the FOMC sees price pressures persisting and has grown more alarmed about the potential unmooring of inflation expectations. The Federal Open Market Committee anticipates that ongoing increases in the target range will be appropriate, it said in a statement after the two-day meeting in Washington. The committee is strongly committed to returning inflation to its 2% objective. The Fed reiterated it will shrink its massive balance sheet by $47.5 billion a month, a move that took effect 1 June, stepping up to a $95 billion monthly pace in September. And the central bank has also revised their outlook for the economy from the soft landing scenario of March to a bumpier touchdown, underscoring the tough task Powell faces as he tries to tame inflation running above 3 times the Fed's 2% target without causing a recession. Having just won Senate confirmation for a second 4-year term, Powell must also re-establish the Fed's inflation-fighting credibility with investors and with Americans who are furious over the soaring costs of living. We'd like to see demand moderating. Demand is very hot still in the economy. We'd like to see the labour market getting better in balance between supply and demand, he said, adding that officials won't declare victory until they see compelling evidence that inflation is coming down. But he dismissed the suggestion that the Fed was trying to induce a recession, saying he saw no sign of a broader slowdown while assuring Americans that higher rates could be borne. It does appear that the US economy is in a strong position and well positioned to deal with higher interest rates, he said, and the Fed aims for 2% inflation measured by the Commerce Department's Personal Consumption Expenditures Price Index, which rose 6.3% in the 12 months through to April. That's a 40-year high. Policymakers now forecast the gauge to advance 5.2% this year, up from 4.3% in the March projections, and they forecast gross domestic product growth to slow to 1.7% this year compared with a 2.8% expansion projection in March. Unemployment could rise to 4.1% at the end of 2024 from 3.6%. The FOMC vote, which included newly sworn-in Governors Lisa Cook and Philip Jefferson, included a dissident from Kansas City Fed President Esther George, who preferred a half-point increase. Powell will testify before Congress over 2 days next week, where he can expect to be challenged over his central bank's performance. Having spent most of 2021 predicting that the post-pandemic inflation surge would ease, policymakers have been repeatedly forced to rethink how high they expect to raise rates, sending financial markets into spasms as investors adjusted to the risk of recession. In fact, recent data showed household and business spending have largely held up, though a retail sales report earlier on Wednesday suggested demand moderated in May. But persistent hot inflation poses a major political problem for President Joe Biden and the Democrats, who are defending their thin congressional majorities in November's midterm elections. And that early economic data on Wednesday showed that US retail sales unexpectedly fell 0.3% in May as motor vehicle purchases declined amid shortages and record high gasoline prices pulled spending away from other goods, well short of expectations calling for a 0.2% rise. Most of the incremental data points have been negative. Even this morning, the retail sales numbers were soft, so just in the last 4 business days, you've had a number of negative economic numbers, said Ellen Hazen, Chief Market Strategist, F.L. Putnam Investment Management. But once the Fed chairman said that there could be a similar 75 basis point increase next month, that's when the markets rose, said Sam Stovall, Chief Investment Strategist at CFRA Research in New York. It's a sort of vote of confidence that the Fed is finally awake to the inflation problem and is willing to take a more aggressive stance. The Dow Jones Industrial Average rose 303 points, or 1%, to 30,668. The S&P 500 gained 1.46% to 3,788. And the Nasdaq Composite added 2.5% to 11,099. The 5-session losing streak for the S&P 500 was its longest since early January, and Treasury yields, which had gained momentum in the days leading up to the decision, fell sharply, paving the way for the growth stocks to rack up gains. Apple, Amazon, Meta Platforms, Alphabet, and Microsoft were all sharply higher. And semiconductor stocks also led, with Advanced Micro Devices and Nvidia both up. Among individual stocks, Citigroup rose 3.52% as one of the best performers of the S&P 500 bank index, which gained 1.6%, and New Corp advanced 2.41% after it forecast upbeat current quarter profit on strong steel demand. Boeing surged 9.46% after China Southern Airlines conducted a test flight with a 737 MAX plane for the first time since March, in a sign the jet's return in China could be nearing as demand rebounds. The recent decline in mega cap valuations, together with expectations that Fed hawkishness is nearing a peak, has attracted some on Wall Street to return to growth sectors of the market. As we're getting closer and closer to seeing peak hawkishness, potentially by the end of the summer, and given where valuations have gone for this growth area of the market is ultimately compelling, Timothy Chubb, Chief Investment Officer at Geared Partners, said. We've been positioned that way now for the last month. Beaten up consumer stocks clawed back some of their recent losses, supported by travel and leisure stocks. Caesars Entertainment Corporation, Norwegian Cruise Line, and Penn National Gaming were all up more than 4%. In fact, energy was the sole sector in the red, as data showing US weekly crude inventories unexpectedly increased as domestic production jumped to its highest level since April 2002. APA, ExxonMobil, and ONEOK were among the biggest decliners, down by about 1%. In fact, Bitcoin also rose in sympathy, up 2.35% to 22,693, but had earlier visited the realm of 20,000 US, as evidence of deepening stress within the crypto industry kept piling up. There's a growing sense of anxiety about the stability of crypto projects, large and small. Tron founder Justin Sun's roughly month-old stablecoin USDD drifted from its intended dollar peg, at one point dipping below 96 cents. And a tweet from the co-founder of crypto hedge fund 3 Arrows Capital fueled speculation that it had suffered large losses. Bitcoin fell as much as 8.6% on Wednesday, down to 20,081. The largest token had fallen for 9 straight days. That's the longest losing streak since 2014. And Ether was on the cusp of breaking the $1,000 mark after a 10% plunge. A market that started sliding late last year on expectations of tighter monetary policy is now showing signs of widespread panic after last month's collapse of the Terra blockchain and the recent decision by crypto lender Celsius Network to hold withdrawals. Even long-term holders who have avoided selling until now are coming under pressure. What we're seeing now are the weak hands exiting the market as we wash out the excess of what, in retrospect, can only be seen as an overextended build-up of speculation and leverage, said Matti Greenspan, founder of Quantum Economics. Historical data shows that Bitcoin may find key support levels around the $20,000 mark, as previous sell-offs demonstrated where the token usually finds points of resilience, according to Mike McGlone, an analyst for Bloomberg. Prices may build a base around $20,000 as it did at around $5,000 in 2018-19 and $300 in 2014-15, he said. Declining volatility and rising prices are earmarks of the maturing digital store of value. But fresh apprehension was triggered on Wednesday, with traders closely watching developments from the Tron DAO Reserve, the entity that oversees the cryptocurrency reserves backing USDD. The group said on Wednesday that it planned to withdraw 2.5 billion TRX tokens from the Binance crypto exchange in an apparent attempt to counter the selling pressure. Sun has repeatedly taken to Twitter this week to tout efforts to support USDD's peg. The Tron Network's governance token TRX, which has come under attack from short sellers in recent days, has dropped 14% in the past 24 hours. And adding to the market's nerves, the founder of 3 Arrows Capital, an influential hedge fund that has been liquidating crypto holdings, posted a vague tweak. We are in the process of communicating with relevant parties and fully committed to working this out, former Credit Suisse Group AG trader Zhu Su tweeted from his verified account, without providing any further details. The crypto market now stands at a fraction of its height in late 2021, where Bitcoin traded at a heady 65,000 US, and traders poured cash into speculative investments of all stripes. The total market cap of cryptocurrencies is $925 billion. That's down from $3 trillion in November, according to CoinGecko. With prices continuing to dive, there are more predictions that losses will accelerate if key levels are broken. If these levels break, 20,000 Bitcoin and 1,000 Ether, we can expect massive sell pressure in the spot markets as dealers hedge themselves, BitMEX co-founder Arthur Hayes said in a tweet. So you can see here how the dams are breaking, and we are seeing the Fed finally getting to grips with inflation, the market's trying to come to terms with that, and the fallout across multiple asset classes continuing. And if you think this is the end, forget it. This is just the end of the beginning. Market liquidity is still under pressure. Rate rises are coming left, right and centre. The Bank of England will be the next on the list of central banks potentially lifting rates. And we're going to see more ahead in Australia later. We are in a whole new ball game, and as yet, I'm not sure the rules are very clear. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.